Canada depends a lot on selling commodities to fuel our economy, and we know that commodities are notoriously volatile, as demonstrated by the price collapse of one of our most valuable, oil. Joining us now for more on the effects the price drop has delivered in Calgary, Alberta, Jennifer Winter, Associate Director of Energy and Environmental Policy at the University of Calgary's School of Public Policy, and Jeffrey Jones, reporter with the Globe and Mail, and with us here in studio, Elena Cherney, Canada Bureau Chief and Global Resources Editor with the Wall Street Journal. And I'm happy to welcome everybody in Calgary and Elena, you here in Toronto, back to our program. Let's bring these numbers up just to start with, because this shows in stark relief, as it were, what's happened to the price of oil over the last 15 months or so. You know that when we talk about the price per barrel of oil, we're actually talking about Brent Crude, West Texas Intermediate, and Western Canada Select. And look at what's happened to these numbers. From June 2014, when these three commodities were trading at $125 a barrel or $115 a barrel or $94 a barrel, all expressed in Canadian funds, they have gone down, down, down. And you see the arrow on the right of your screen. The percentage decrease from June 2014 to now, 48% off for Brent Crude, 47% off for WTI, 55% off for Western Canada Select. And Elena, let's just get into some basic analysis of this. Why has this happened?
So the bottom line is there's an imbalance between supply and demand, which is usually what affects prices the most. And the specifics, just boiling them down, probably the single biggest factor is the U.S. shale boom, which was not anticipated. Nobody seemed to recognize how much supply would come on stream as quickly as it did from fracking, from shale in the United States. And at the same time, China slowed down. Growth in China has slowed down, which has been a huge factor for Canada, not just in terms of oil demand, but in terms of China's demand for other commodities. So China's demand for energy slowed down at the same time as shale ramped up in the US. And the other factor is that OPEC, which traditionally had played a swing factor in keeping prices up when supply surged, decided to not cut its supply. So again, this just created more and more supply. And
therefore we are where we are. Jeffrey, let me get you to follow up. We saw on that chart that the lines are going down. Is it possible to conclude from the direction of those lines that they're going to be going in that direction for the foreseeable future?
Well, there is a school of thought that we've seen become more and more popular among analysts and certainly among executives here in Calgary, and they call it lower for longer, which says that the factors that are pressuring oil prices will take a long time to alleviate. I mean, we saw, for instance, Goldman Sachs coming up with a new forecast for for oil, saying that should production not decline at the rate that a lot of people figure it will, and should the inventories in the United States continue to be at record highs, it could potentially touch $20 a barrel, which would be pretty devastating for the oil patch here in Calgary, especially.
Well, Jennifer, let me follow up with you. What are the ramifications of oil trading at $20 a barrel?
It's a little bit depressing. The Alberta government has already forecast significant decreases in royalty revenues, and EI claims in Alberta are up 60% since the start of 2015. There have been layoffs, continual layoffs, and if oil went down to $20 a barrel, it would look worse for Alberta, definitely. That said, Alberta's current unemployment rate is still below the national average, so we're not doing too badly right now. $20 a barrel is a different story, though.
Let me ask this, though, Elena. If oil goes to $20 a barrel, in effect, that's like everybody who drives a car or a truck getting a $1,000 or $2,000 or $3,000 tax cut that they didn't anticipate. So are there not positive parts to the economy in all of this?
Yeah, that's a really interesting point. First of all, I'm not sure I buy into the $20, but we could come back to that. Let's just say, even at the levels that we're seeing now, there are offsets for consumers. The problem is that in an economy like Canada's, where we are net exporters and where producing crude energy, crude oil, is such a big part of our economy, not just in terms of what we sell to other countries, but in terms of business investment, employment, some of the factors that Jennifer just touched on, it's really, really difficult for those consumer offsets to outweigh the negative to the whole economy.
So on balance, it's bad. We actually prefer it. Even if it costs more when we go to the pumps, we prefer oil at 70, 80, 90 bucks a barrel.
Well, I don't know what we prefer, but I think it's really difficult to make an argument economically that there is a benefit for the country to having oil at these prices.
Jeffrey, in which case, how are businesses supposed to manage their affairs with this much uncertainty in the air?
Well, we've seen some pretty tough medicine in the oil patch just in this last week alone, or last 2 weeks alone. We saw 900 jobs cut at 2 different companies. This is on top of probably about 35,000 that the oil industry has estimated this year alone. So that's pretty devastating for a lot of families across the province, and not just in Alberta, I might add. Also Saskatchewan and BC as well has slowed down. We've seen everything from asset sales to companies cutting dividends. Just in this last week, we saw Canadian Natural Resources chop its staff pay by 10%. So, I mean, there's a whole range of things that companies are doing to try and cope with this. And just back to Elena's point and the Goldman Sachs $20 mark, I agree with her that there's a reason to be kind of skeptical, because you'll recall back in 2008, they predicted $200 a barrel of oil. So it seems like they're very fixed on the number 2.
The predictions are worth what you pay for them, in other words. Maybe.
Yeah, and it's one forecaster.
One forecaster. Jennifer, let me get you to follow up on that. We heard from Jeffrey how businesses are supposed to make sense of all of the uncertainty on there and plan their affairs accordingly. How about governments? How do you make a budget when you don't know what your revenues are going to be because you don't know what the price of oil is going to be at? How do you oversee an economy when you have no clue what your commodities are going to be trading for?
Well, I would say it's not entirely accurate that we don't know what the price of oil is going to be in, say, 2 years. We know with some certainty. We look at market expectations, and right now it looks like it's going to stay around $50 a barrel and not increase beyond that until about 2017. So a reasonable government is forecasting based on a $50 a barrel price. And, you know, so they have expenditures that maybe outweigh the incoming revenue from the price of oil. And so a reasonable government will be thinking about, oh, what other sources of revenue should they be considering? And here in Alberta, the NDP has increased corporate taxes and has also increased personal income taxes for higher income earners. So they are looking to diversify their source of revenue.
Okay, Jeffrey, can I get you to follow up on that insofar as Jennifer says we can predict with some degree of certainty where oil is going to be over the next couple of years. Do you agree with that?
I think the governments have the ability to plan conservatively, put it that way. I mean, Alberta's been in hot water before, often because they overestimated the price of oil. I mean, this goes back decades. So if they're able to put a pin in a number that is going to be reasonably conservative, then obviously they can do some budgeting. But I mean, in the last year alone, nobody would have predicted that oil would be at $50 a barrel or less. So, I mean, it is a bit of a mug's game, I think.
Right. Elena, let me go to you on this next one, and that is the main criticism. I don't want to talk politics here, but the fact of the matter is the main criticism of Prime Minister Harper that one hears is that even though he's an economist, he has kind of put too many eggs, if I can put it this way, in the resource basket, and he hasn't championed a diversification of the Canadian economy enough. What are you hearing people say about whether that's a fair criticism?
I think there are a couple of parts to that answer. The question of whether other policies and other strategies should have been deployed to make parts of the economy more dynamic, manufacturing, et cetera, I think is one question you can ask, and that's a legitimate question. I think in terms of Canada's dependence on commodities, it may be not entirely fair to blame this government or even the last few governments for a structural economic model that's been part of our country for centuries. And what another interesting way of looking at it is to think about other rich countries that have similarly been very badly hit during this downturn, not just by crude, but by mining. So Canada's got a double whammy right now. We've got crude oil, but also mining. Base metal prices have collapsed, iron ore, and that's another big part of our economy. If you add up energy and mining, some would argue that directly and indirectly, those industries account for about 23% of the Canadian economy. And if you compare with other countries, look at, for example, Norway, Australia, other very well-off countries, OECD countries that are similarly dependent on those industries, no one else is skating through this either. And neither of those countries, despite their wealth, Norway is a really interesting example, has managed to create a really diversified economy. It's very, very hard to wean yourself off a rich resource sector, especially when things are going well. In which case, Jennifer, unfair to say that Prime Minister Harper hasn't been an adequate champion for the further diversification of the Canadian economy? What's your view?
Well, I would say that in reality, politicians can do very little to affect the economy. And it's only over the long term they can affect the economy through taxes and government expenditure, but that's still only minor long-term effects. And in terms of the dependence of the Canadian economy on the resource sector, the reality is that the resource sector has generated a good return on investment, and that's why it's been successful in the boom. And I'm not sure that there is, or no, I am sure that there shouldn't be a role for government in interfering in that and, propping up other industries that aren't doing as well.
Jeffrey, you're in Calgary. What are people saying in Stephen Harper's adopted hometown now about whether or not he hasn't diversified the economy enough?
Well, I mean, the oil industry could not argue credibly that they have not had a government that has been probably the most sympathetic to its aims ever. So I mean, it's diversification of the national economy has not been an issue in this province, probably until very recently. And sort of one side of this, of what had happened during the so-called commodity super cycle was that the Canadian dollar took off, making manufacturing in other parts of the country a much weaker proposition. Now that we've gone from super cycle to stupor cycle, we've seen a little bit of response in manufacturing in other parts of the economy as the Canadian dollar has weakened, but it certainly has not roared back to any extent that people had predicted before. Not even close.
Let me ask you, Ellen, about pipelines. When oil's at $125 a barrel, it may make more sense to be building Keystone XL or Northern Gateway. How about if oil's at $40 a barrel? Is the priority that the federal government has placed on getting those projects done, does that still make sense?
Well, the economic argument is that actually it's even more important because the chart that you showed at the beginning highlights the differential between Canadian crude, the price that Canadian producers get for their crude, and that of West Texas and Brent crude. So Canada's oil trades at a discount. It is cheaper than those other types of crude. And that's partly because it's heavier oil and it's more of a process to refine it. But the more access Canadian producers have to more refiners and more markets, the smaller, in theory, that differential gets, and the more value Canadian producers can capture. So the argument for building pipelines in the long term is probably not altered. And I think also to the point that Jennifer was making and Jeff was making, I mean, longer term, there will be eventually a rebalancing and between supply and demand. Canada's oil sands are the third biggest reserve in the world. The world will need that crude, and those pipelines are not 6-month or 1-year or 2-year projects. They're multi-decade investments.
So Jeffrey, we got to wait this out. What's the mood out there in Alberta right now while we wait out oil returning to a price that's going to make people who produce it happier?
You know, I was thinking about this as I was driving in, and certainly, you know, there was a lot of nervousness going into the spring. We saw a little bit of oil rebound around April and May, and and then crude started to fall again in June. And at that time here in Calgary, of course, we had the stampede, which is a bit of a party atmosphere anyway. So, you know, we saw a little bit of austerity in terms of the corporate parties and that type of thing, but the mood was still quite good. But I think when crude fell back into the 30s, back at the end of August, and we went into September with more news of job cuts and low oil prices, it really became kind of a dour mood, certainly in downtown Calgary. There's no doubt about it.
Jennifer, can you follow up on that in this respect? I do remember in Ontario in 1990 when the NDP won the provincial election, which nobody saw coming, and there was a kind of, among people who thought it was a pretty cool story, a euphoria in the air, very quickly followed by the worst recession since the Great Depression. You know, you can't help but see history repeat itself in Alberta right now as people saw the Rachel Notley NDP government elected. Nobody saw that coming. And now here's, you know, its first budget, some pretty tough economic news. What's that doing to the mood of Alberta today?
Well, I think the Notley government inherited a tough situation that wasn't the fault of them or even the Prentice government or the Redford government before that. I mean, the reality is Canada is a small open economy and Alberta is a small part of a small open economy. So there isn't a whole lot the government can do. In terms of mood around the government and the situation, I would say that there's a bit of a wait-and-see attitude. I know that the industry is a little bit unhappy about a simultaneous royalty review and a climate change review. But, I mean, the Notley government, they're following through on their election platforms, which is, I think, a good thing from their point of view. And the reality is they want to be re-elected in 4 years, and I think that they are going to do the best job they can to keep the Alberta economy going.
Does the price of oil, Elena, in your view, have an impact on how the federal election might turn out?
I think the economy obviously
in general
has an impact, and the price of oil is an enormous part of what we're seeing in the economy. I mean, the contraction in the first half of the year, the job losses that Jeff was outlining have an impact across the country. People don't realize. I mean, there was a huge manufacturing, part of the manufacturing economy, even in Ontario, that was geared towards supplying the oil patch, and people are feeling it across the country.
Jeffrey, what about your view on that? Does the price of oil potentially have an impact on who wins this election?
I think it plays a role, sure. I mean, if you take a look at whether it's deserve it or not, you know, the Harper Conservatives have been very friendly to the oil patch, and whether or not it was up to them to put the oil patch in a position where it was the biggest contributor to national exports, whether or not it had anything to do with that at all, they're certainly, you know, for want of a better term, tarred with that. So, sure, I think absolutely. As Elena said, oil is huge in the economy. If you take a look, there was a DBS report that came out last week, the bond rating service, where there was an amazing chart that showed just how tied the price of oil is to Canadian GDP now. You know, it was under the Harper government's watch, so absolutely, yeah.
Gotcha. My thanks to the three of you for this discussion tonight. We appreciate you coming on TVO and having it with us. Jennifer Winter, Associate Director of Energy and Environmental Policy at the University of Calgary School of Public Policy, beside Jeffrey Jones, the reporter with the Globe and Mail, and Elena Cherney, Canada Bureau Chief and Global Resources Editor with the Wall Street Journal. Thanks, everybody.
Great to be here.
Thanks.
Help TVO create a better world through the power of learning. Visit supporttvo.org and make a tax-deductible donation today.